let's take that conversation forward. Dr. Fereidun Fesharaki. Dr. Fesharaki, fantastic to have you on ET Now. On behalf of everyone from ET Now, thank you for joining us.
Thank you.
Dr. Fesharaki, when we spoke last time, there was no war in the world. Now, where is oil and where is crude headed?
Well, based on the fundamentals of supply and demand, the price today ought to be in the range of $85 to $90 a barrel. Anytime that the price is above that $85, $90 is because of the geopolitical issues. Mostly at the moment is the Russia-Ukraine crisis. And a lot of it is sanctions or self-sanctioning in Europe, which is creating the crisis. So we're paying about $30 a barrel too much because of the emotions and politics, not because of the fundamentals.
So do you then expect oil prices to come down significantly? When I say significantly, oil currently is at $115 per barrel. If you feel that it will settle between $80 to $90, that means according to your 15-20% correction is coming.
If there is the end of the war with Russia, yes. If there is the Europeans' lack of self-sanctioning, yes. The issue that we need to remember is that Russia exported 7.7 million barrels per day of crude and products, 5 million of crude, 2.7 million of refined products. There is nobody in the world which can replace them. It's sort of the politics of saying Mr. Biden wants to talk to Saudi king, so the Saudi king replace them. This is all totally a nonsense. There is no way anybody can have 7.7 million barrels per day of crude and products available to replace the Russians. So if you don't want to buy the Russian crude, the answer is that you have to have a high oil price. And I think that countries like India, which have decided to buy the Russian crude, are not only making a rational decision for themselves, but they're also helping the world. Because not buying Russian crude just makes it more and more expensive.
Dr. Fesharaki, we are headed towards a big slowdown in the world. According to estimates, Europe actually could be on a brink of recession. US economy will slow down significantly. China has slowed down significantly. What happens to the natural demand of oil, irrespective of the war or sanctions?
Well, last time in 2007 and 2008 that we had a recession, we can lose 2 million barrels per day of oil demand. And the oil prices could go down significantly. But you have to have a full-scale recession. Slowdown is not enough. Right now, the oil demand is expected to grow by 2.8 million barrels per day this year. Before the China lockdowns and before the increase in interest rates, our number was 4 million barrels per day. So now it's gone from 4 to 2.8 million. But to make it into zero or negative, you have to have a full global recession, which is definitely not possible. But as of now, I think the chances are less than 25%.
Dr. Fesharaki, most of the Western countries have decided to release oil from their oil reserve, things which they've used during emergency and war times. And there seems to be a concentrated effect by Japan, US being the largest, and then UK. How come that is not having impact on underlying oil prices?
Because the total amount of release is 1.2 million barrels per day for 6 months. And the market knows that this is temporary. 1.2 million barrels per day for 6 months is equivalent to what the Chinese oil demand loss has been because of the lockdowns. So it's important, but it's not that significant. The number is not big enough to make a global change. Let's say if the agreement with Iran is signed, then the Iranians can bring in 2.5 million barrels per day in the market right away. That could make a big impact. But if you have something which is temporary for 6 months, about 1.2 million barrels per day, it does not make a significant impact.
Dr. Fisharaki, while Europe is looking at imposing sanctions and they want to make the region not dependent on gas from Russia and oil from Russia, Russia has found alternate buyers and India being one of them. How does this change dynamic? Because if Russian oil goes to other alternate buyers, will that change the equation?
Well, the Russian oil at the moment, the Russian oil which is shut in, is about 1 million barrels per day. The rest of Russian oil is moving and is moving to Eastern markets. India is a big buyer, but also the Chinese are buying. Several other countries are also buying. The question really is that one part of the sanction, which is not finalized as yet, is that will they suspend insurance on seaborne shipping for Russian crude? That could make a big difference. You know, when you want to buy Russian crude today, if you buy diversions from Europe, the cost of shipping to Indian buyers could be up to $15 a barrel. So shipping has become very expensive. Now, if they suspend the insurance, no matter how much discount they give, it is not so easy to buy it anymore. As of today, that decision has not been made, but it's being discussed that every ship carrying Russian oil would automatically lose its insurance. And so they refuse to take the cargo.
When do you see new capacities getting added up in oil? When we speak to oil producers and oil ancillary companies, they are telling us it's in process which could take at least 2 to 3 years.
There is nobody has enough capacity to replace Russian oil. Anybody who claims that is nonsense. You cannot replace Russian oil. The Saudis are planning to add 1 to 1.2 million barrels per day capacity until 2027. So 5 more years. Abu Dhabi plans to add 1 million barrels per day within 8 years by 2030. But there is nobody has oil ready made that they can bring to the market to replace the Russian crude. So the answer to Russian crude, if the buyers don't want to buy Russian crude, the prices have to go up to about $150 a barrel to kill the demand and create a global recession. That is the only way that you can make it work. So what the Europeans are doing is that they're creating a global recession for the rest of the buyers around the world, including all of the buyers in Asia. Because the Europeans are so angry at the Russians, but the policies that they follow, whether it's for climate change, whether it is for emotional issues on Russia, all of these things impact the rest of the world. They can afford maybe to pay the $150 oil, but the rest of the world cannot afford to pay it. So I'm afraid that I blame a lot of these problems at the door of the Europeans who follow policies without caring about the cost that it creates for the rest of the world.
Oil going to $150, Dr. Fisharaki, next 6 months. Is that an outside possibility or a high probability event?
$50 oil?
No, $150. 150, sir.
$150 oil. $150 oil happens once the Europeans, if the Europeans put the sanctions on insurance from exporting to Russia, and by the end of the year, when the Russians' oil is going to be extruded from Europe, in most of the countries in Europe, if the insurance sanction is placed, I think $150 is a real possibility.
Are you a bit surprised that despite such high oil prices, there is no deal between Venezuela and Iran? The oil from both these countries is still off market.
Well, Venezuela doesn't have much oil to contribute. This is the reality of it, is that the Venezuelan oil industry is destroyed by the government in Venezuela, by the mismanagement. So even if there is no sanction on Venezuela, maybe they can add $300,000-$400,000 per day, and that's it. But in the case of Iran, it's very different. Iran has about 150 million barrels of oil in storage, which can be released tomorrow, right away hit the market. And then they can increase oil production by between 2 to 2.5 million barrels per day within 90 days. So the case of Iran is very dramatically different from Venezuela. The oil is ready to go. They just need to reach an agreement. And at the moment, it seems that the Iranian side is the one which is dragging their feet.
When we spoke to you last time, sir, you said that oil would trade above $100 and the bias would be positive. That was a conversation we had in Feb. Now it's June, 4 months after that. Do you think the bias will now be negative or the bias will still be positive?
But the buyers are now feeling the pain in the market. The oil market, the rich countries cannot afford it. And the third world cannot afford this either. It's too expensive. And so if we keep pushing the price of oil higher and higher, we guarantee that a global recession will come. And global recession will hit everywhere, the rich and the poor, the first world and the third world. So I find myself that in an environment that so much of this thing is self-inflicted wound. And so much of it comes because of the insistence on sanctioning Russian oil and gas. Russian gas cannot be sanctioned because the Europeans cannot function. But the Russian oil can be sanctioned, and the world will pay a high price. It is not simply one group which pays a high price. The whole world pays a high price. The Europeans make bad policy decisions, and the rest of the world suffers.
So last cycle, and I'm talking about 10 years ago when oil prices were above $100, large part of the demand was led by China. The economy had a different base. It was growing at 9-10%. The Chinese were also going through a large process of economic growth. That factor is missing. Now that China is about to open up post-COVID restrictions, what role do you think China will play in terms of oil demand?
China is still very important. The oil demand growth in China is still very big. But you're right. Before, they led the world in a very big way. But at the moment, what we have is a supply issue. Before, we didn't have a supply issue. A supply issue comes from two problems. One problem is that there are physical restrictions. Basically, the world is struggling to produce enough oil. And we forecast that we have another 10 million barrels of oil demand in front of us before the oil demand peaks in 2030s. So we still have a lot of oil demand, but we don't know where the supply is going to come from, which means the prices could be higher as we go forward. The other part is all these ESG pressures. Again, led by Europeans, pressure on the oil companies not to invest in oil, pressure on the oil companies to sell their refineries, pressure that by the activist shareholders that only invest in anything to do with renewables, don't invest in hydrocarbons. They say we don't want oil, we don't want gas, we don't want nuclear, and we don't want coal. So if you don't want all of it, then you have a problem. But it is underinvestment in oil production, underinvestment taking place in refining, and a lot of it because of ESG pressures. And all of these things are ending up making the supply lag behind the demand and creating these current prices in front of us.
Dr. Fesharaki, you also track the oil technicals very closely. What's happening in the F&O market? What is happening in the oil leverage market? I've been told that the oil future positions in terms of net long is one of its highest ever. So do you think there is also a lot of speculative built up in oil market right now, largely because on the trading side?
There is a lot, but we need to understand what drives what. At the moment, it's the Russia crisis which drives the oil market. And a lot of the traders building speculative positions, they follow that and try to make it worse, make it more aggressive to make extra money. But they are not the cause of the problem. The cause of the problem is that the market fundamentals are tight and the sanctions against Russia. These are the real reasons that the current problem exists. If this situation was not there, the speculative positions would be much, much smaller.
Dr. Fesharaki, it's quite ugly and bitter between Russia and the Western allies. So let me construct a scenario that the war comes to an end, but the sanctions against Russia are not removed. What happens in that scenario? Do you think for oil to come down, sanctions have to be removed? End of the war may not be the peak for oil prices?
I think if there is a ceasefire, and as part of a ceasefire, there would be some significant easing of the sanctions. If Mr. Putin decides to retire early, I think the problems can be solved much, much earlier. But if Mr. Putin stays there, and legally he can stay as president until 2036, which is another 14 years, that would mean that even if there is end of the war, full removal of the sanctions is not going to take place. But if Putin is not there, I think the sanctions can be removed very quickly.
Dr. Fesharaki, we've also seen an extraordinary expansion in global refining margins. We've seen how the crack spreads have gone higher. What are your thoughts there, sir? You think everything what is happening in the petrochemical chain will also start normalizing now?
Well, the reality is that, the sanctions against Russia are much more effective on the refined products, less effective on crude, but much more effective on refined products. All these issues that you see in the market, such as the high cracks that you mentioned, we had gas oil crack reaching $50 a barrel, which is unprecedented in history. This is because of several reasons. Most important reason is the loss of supplies of refineries from Russian refineries. But also that 4 million barrels per day of refinery capacity was closed down during the COVID-related issues. And the third important reason is that the Chinese have decided that they don't want to export refined products. And they have cut the refined product exports as a political decision, not an economic decision, by 50%. And they intend to make the refined product exports to go to zero by 2025. Their argument is that I don't want to import from Saudi Arabia and export refined products and leave the carbon footprint at home. So that's the official answer that is given. But it is the decision of the President Xi Jinping in China that China should get out of the exports of refined products. That has made the refining margins much stronger. So combination of demand coming back, then refinery closures, Chinese much lower exports, and the loss of the Russian refineries. Well over 1 million barrels per day of Russian refineries have closed down because the Europeans don't buy Russian products. And Russian products, many of them were supplied by pipelines. So it's not something that you can put on a ship and send it to India, except that India itself is a big exporter of refined products. But that change in the system of the Europeans impacting the Russian refined products is, I believe, mostly responsible for the high cracks.
So last question. The summer season is almost getting over, and then the winter demand will start kicking in, let's say from October and November onwards. Are we in for any more sharp adjustments because of this winter effect and the summer effect?
Well, we always are. Actually, the summer season in US and Europe is just starting, which there would be a lot of gasoline demand coming in that market. The issues, again, most important issue is what happens to the sanctions on Russia. That drives the market. Everything else is far less important. And if, because of these sanctions and because of the European policies, we end up in a global recession, then it would be big adjustments downwards, as there would be unemployment rising, lots of people would be seeking jobs around the world. We also have a terrible inflation at the moment on our hands. We have a food crisis, we have a metal crisis, we have a commodity crisis. It's not only the oil crisis. All of these things hand to hand could create a very sort of ugly environment for the many countries in the third world.